Welcome to the Deep Dive. We're here to give you the shortcut to being the most informed person in the room.
And today we're digging into something really fascinating. UPS's third quarter 2025 results.
Yeah, fascinating and honestly a bit counterintuitive. We're looking at a huge strategic pivot happening right now.
Exactly. This isn't just numbers on a page. Our mission today is to analyze how UPS is, well, shrinking on purpose. They're cutting volume.
It sounds wild, right? Reducing volume. But the idea is to ditch the high volume, low margin business. Think big parts of Amazon, general low profit e-commerce.
And shift focus. They're moving hard towards profitability, towards high-value, complex logistics, things like healthcare, specialized B2B shipping.
It's a huge bet. Deliberately getting smaller in some areas to get stronger financially.
Yeah, it's about de-risking and optimizing. So the core question for you listening is, can dropping volume actually lead to better financial health for a giant like UPS?
Well, let's look at the top line. The headline numbers are pretty telling. Consolidated revenue for Q3 2025, $21.4 billion.
A solid number. But the real story, as you said, is the margin. Non-GAAP adjusted operating margin hit 10.0%.
Okay, 10%. And how does that compare?
That's an expansion of 110 basis points year over year. So for anyone not tracking this stuff daily, that's a 1.1% improvement in their operating margin.
While undertaking this massive strategic change.
Exactly. During a huge operational overhaul, it strongly suggests that, for now at least, this focus on quality over just sheer quantity is working.
All right, let's break it down. Where is this pivot most obvious? I'd say the U.S. domestic segment. That's the real test case.
Absolutely. And the first thing you notice is the volume dip. It's pretty stark.
Yeah, average daily volume, ADV down 12.3% compared to last year. That's a significant drop in packages moving through the system.
A massive operational contraction. And normally in logistics, less volume equals less density, which usually means higher cost per package. It gets less efficient.
But this drop wasn't exactly an accident, was it?
Not at all. It was largely planned, maybe even engineered. They knew this was coming.
So who are they intentionally shedding? What kind of volume?
Two big chunks, really. First, that planned glide down, as they call it, of Amazon volume. They're reducing their reliance there.
Okay.
And second, they've been deliberately cutting back on the lowest yielding e-commerce traffic. You know, the cheap stuff that costs more to deliver than it brings in. Basically, trimming the operational fat.
Okay, here's the part that, well, makes you pause. Despite that big 12.3% volume decline, the U.S. domestic operating margin actually increased. Only slightly, 10 basis points, but it finished at 6.4%.
Right. It went up.
How is that even possible? More margin with fewer packages? It kind of defies the basic logic of network efficiency, doesn't it?
It does, until you look at the quality of the revenue. The key metric here is revenue per piece, or RPP.
RPP, so how much they make on average for every single package.
Exactly. And that metric shot up by a huge 9.8% year over year.
Wow, 9.8%? That's enormous.
It tells you the packages they kept were way more profitable than the ones they let go. The sources actually highlighted this is the strongest RPP growth they've seen in 3 years.
Okay, so where did that almost 10% RPP boost come from? Can we break it down?
Yeah, the breakdown really confirms the strategy's working. The biggest piece, a full 400 basis points of that improvement, came from better customer and product mix.
400 basis points. So like 40% of the RPP gain was purely because they shifted who they were serving and what they were shipping. That's strategy in action.
Absolutely. Pure strategy execution. The rest came from, well, good management. Base rates and package characteristics added 350 basis points.
Meaning better pricing and just better, maybe denser or easier to handle freight.
Right. And then fuel surcharges added the remaining 230 basis points. But that 400 basis point mix improvement, that's the pivot right there.
You can really see it in the customer mix numbers, too. Small to medium businesses, SMBs, they now make up 32.8% of the total U.S. volume.
Which is a 340 basis point jump from last year. That's significant.
And business to business, B2B.
B2B hit 45.2% of U.S. volume. That's up 350 basis points.
Why are SMBs and B2B so crucial for profitability?
Well, they generally mean more predictable volume, often higher value shipments, and critically, fewer expensive residential deliveries. More drop-offs at businesses, which save time, saves miles, saves money per stop.
Makes sense. And the flip side proves the point. Business to consumer, B2C, volume was down sharply, ADV fell 17.6%.
Yeah, so it's clear this isn't just a temporary blip. It's UPS fundamentally retooling its domestic network, moving away from just being a bulk carrier for online shopping boxes.
And towards serving the more complex, maybe higher touch needs of businesses.
Exactly, a structural re-engineering of the U.S. business.
Speaking of reengineering, let's talk about the sheer scale of the operational changes. That Amazon glide down is part of it, but it's enabling this massive network reconfiguration, the biggest in their history, they say.
It's monumental. The cost reduction targets are staggering. They're aiming to take out roughly $3.5 billion in related costs just in 2025.
$3.5 billion. How much have they achieved so far?
They're well on track. $2.2 billion reduced year to date. And this isn't just, finding a few efficiencies here and there. This requires major changes to their physical operations.
Like what? Give us some concrete examples of what that cost-cutting looks like on the ground.
Well, fewer buildings, for one. They've closed 93 facilities so far this year. 19 of those closures happen in Q3 alone.
93 buildings. Just think about the logistics of shutting down almost 100 hubs or centers while keeping the rest of the network running smoothly.
It's incredibly complex. And then there's the workforce side. Total operational headcount is down by nearly 34,000 positions compared to last year.
34,000 roles. That's a huge number of people impacted.
It is, though they managed a key part of that quite smartly, using a voluntary retirement program for their long-term drivers.
Ah, right, the driver buyout. What was the cost benefit on that?
It was pretty striking. The total cost for the buyout program was $175 million.
Okay, and the savings, I remember seeing the annual payback was $179 million.
That's right, an annual payback slightly more than the one-time cost, meaning the entire program paid for itself in less than 12 months.
Wow. That's surgical financial management.
It really is. They're replacing higher cost, very senior staff with presumably lower cost labor over time, locking in significant long-term savings while trying to minimize disruption. World-class execution there.
But the efficiency drive isn't just about cutting buildings and staff, right? It's also about making the remaining network smarter, the whole Network of the Future initiative.
Exactly. Using technology to sweat the assets they keep. Automation is key here.
How much progress are they making on that front?
They deployed new automated systems in 35 facilities just in the past year. This is crucial for handling that complex, higher-margin freight efficiently and accurately.
And what does that mean for the volume going through automated hubs?
They expect 66% of U.S. volume to move through automated processes in the fourth quarter of 2025. That's up from 63% last year.
Okay, a 3-point gain. Might not sound huge, but across their massive scale.
It represents significant investment and progress. And you see the results internally. Their own production metrics are showing big improvements.
Like what?
Inside operations, production rates, basically how fast they sort stuff inside the buildings, are the best they've been in 12 years.
12 years, okay.
And preload rates getting packages onto the delivery trucks efficiently are the best in 20 years. Domestically, they're running the tightest operation in decades.
That domestic margin story is impressive, especially with the volume drop. But what happens when UPS faces major global challenges? Let's shift to the international segment. It sounds like a much rockier picture there.
Well, yes and no. The underlying international business volume is actually growing. ADV was up 4.8%, which is the fourth straight quarter of growth. Europe and the Americas led that.
Okay, so demand is still there internationally.
Yes, but it got hit by what the CEO called the most profound shift in trade policy in a century. That's a pretty strong statement.
A century. Okay, what specific policy shift caused such a massive disruption?
It was the global elimination of the U.S. import de minimis exemption. Sounds technical, I know.
De minimis, right. That's the rule that let low-value packages under $800 currently come into the U.S. with minimal customs hassle.
Exactly. Basically, they sailed through. But when that exemption was removed globally, suddenly all those cheap e-commerce items, especially from places like China, needed formal customs entry. Paperwork, processing, the whole deal.
Oh, wow. So the administrative burden must have exploded overnight.
Exploded is the right word. Look at the numbers. Daily customs entries UPS had to handle surged tenfold, from about 13,000 packages a day back in March to 112,000 a day by September.
Whoa. How did they even cope with that? Hire thousands of customs brokers?
This is where their tech investments really paid off. They used AI artificial intelligence to digitally process over 90% of those cross-border transactions.
So AI basically absorbed that regulatory tsunami?
Pretty much. It let them manage that unprecedented paperwork surge without needing a massive immediate hiring spree. But It wasn't frictionless.
Right, because processing still takes time, even with AI.
Exactly. And that friction slowed things down, particularly on certain high-volume routes. The crucial China to U.S. lane saw its average daily volume drop by over 20% in Q3, largely because of this customs bottleneck.
And that slowdown had a real dollar impact.
Oh, yeah. They estimated about a $60 million hit to operating profit in Q3 just from this trade lane shift. And they're projecting it could be $75 million to $100 million impact in Q4.
Man, it really shows how vulnerable even sophisticated global networks are to sudden policy changes.
It does. And it underlines why they're pushing so hard into growth areas that are maybe less volatile, less exposed to these kinds of shocks, like healthcare logistics.
Right. They mentioned strong revenue growth there again this quarter, high complexity stuff.
Temperature-sensitive, time-critical deliveries. And they're building out that capability. That acquisition of Andlauer Healthcare Group in Canada, it's set to close in early November.
Strengthening their North American healthcare footprint.
Precisely. And we shouldn't forget the other big growth engine, the Digital Access Program, DAP, for small medium businesses.
We saw how important SMBs were domestically. How's DAP doing globally?
It's booming. Generated over $2.8 billion in global revenue in just the first 9 months of 2025. That's up 20% year over year.
2.8 billion. From how many businesses?
Over 8 million SMBs are using it worldwide. So that focus on higher yield small business customers, it clearly works across borders too.
Okay, let's look towards the end of the year and beyond. There are still some operational challenges, right? Like the Ground Saver product.
Ah, yes, Ground Saver. That's their service for, well, really low-yield e-commerce, the stuff they're generally trying to move away from.
Volume there was down huge, 32.7% year over year, which fits the strategy, but it still caused problems.
It did. It created a $100 million cost drag in Q3. Even with less volume, if the remaining packages are scattered inefficiently, it kills your delivery density and hurts profits.
$100 million drag. So they need to fix it or get rid of it entirely. What's the plan?
The plan involves a renewed partnership with an old partner, the United States Postal Service, USPS.
Okay, how does that help?
They've reached a preliminary understanding on rates and revenue sharing. Essentially, UPS will leverage the USPS's strength in final mile delivery for this type of freight.
Ah, so UPS handles the long haul, the middle mile, where they're efficient.
Exactly, moving big volumes between hubs. And then the USPS, which already goes to every address every day, handles the final costly residential delivery leg. It plays to each organization's
It
strengths.
maximizes density for both, presumably.
That's the goal. UPS improves its network density, reduces those costly individual stops for low-value packages. The sources say this should start creating real economic benefits in the second half of 2026.
Turning that $100 million drag into a potential positive contributor down the line, both for the package business and their mail innovations unit.
It's smart, long-term thinking, addressing a known weakness strategically.
Okay, final stretch. Peak season. Holiday shipping. What's the outlook? Customers scaling back because UPS is shrinking.
Interestingly, no. Their top 100 customers, the ones driving about 80% of the holiday surge, are actually forecasting a good peak.
Meaning?
They're projecting a volume surge about 60% higher than current levels during peak season. So the big guys are still planning for a busy holiday.
But overall, U.S. peak volume will still be down compared to last year.
Yes, because that Amazon glide down is still ongoing through Q4. So total volume, lower. But the key for UPS is handling the surge efficiently, without killing their margins.
And that's where all the network changes and automation come in.
Precisely. They can handle the peak surge with less reliance on expensive temporary resources, fewer seasonal hires, fewer leased trucks, trailers, even aircraft. The permanent network is just that much more efficient now.
So they're aiming for their most efficient peak ever.
That's what they said. They're aiming for their 8th consecutive year of industry-leading service levels during peak 2. Reliability is paramount for those high-value customers they're courting.
Makes sense. And all this transformation, it's happening from a position of financial strength, right?
Absolutely. Year-to-date free cash flow was $2.7 billion. That's solid.
And the outlook for Q4.
Strong. They expect consolidated revenue around $24 billion. And importantly, consolidated operating margin between 11.0% and 11.5%.
So not just stable, but actually predicting increased profitability as they close out the year.
Correct. And even after paying for that Andlauer Healthcare acquisition, they expect to end 2025 with about $5 billion in cash on hand.
So they have the resources to keep executing this strategy without financial pressure.
Exactly. They're not doing this out of desperation. They're doing it from a position of strength. It's aggressive strategic optimization. A textbook case, really.
So let's wrap up this deep dive. The big takeaway, I think, for anyone watching business transformation is that UPS is showing it's possible. They're deliberately, successfully trading volume for better profitability.
Yeah, through a really focused strategy and, frankly, a massive operational overhaul.
Mm.
They're proving that sometimes you really do have to be willing to get smaller in some ways to get truly better overall.
It's all about optimizing the network for long-term value, prioritizing that complex, high-service, high-margin business.
Building a business that can command a premium because it handles the tough stuff, the specialized needs that maybe others can't or won't.
Okay, so the final provocative thought to leave you with, it centers on that global volatility we talked about. The CEO mentioned profound permanent shifts in trade flows. The whole landscape seems to have changed.
Right? The old equilibrium is gone.
So as UPS keeps leaning into domestic complexity, B2B, healthcare, and automating its core network, the big question is, how long until this new global trade environment stabilizes enough for their international segment to get back to its historical high-teen margin levels? What has to happen for that?
And beyond just AI for paperwork, what are the next innovations needed to make high-value, complex cross-border trade truly smooth, truly friction-free in this new era? That stabilization point and the tech needed to navigate it. That's the next big chapter to watch.
A fascinating transformation indeed.
Definitely one to keep an eye on.
Absolutely. Well, that's all for this deep dive. Thanks for joining us, and we'll catch you next time.